This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gordon Long with GordonTLong.com, and I have with me this morning a couple of noted and well-recognized financial authorities and writers on the web. No stranger to our regular listeners is Ty Andros, the president of TraderView, publisher of the TedBits website, and writer and editor of a very well-recognized newsletter also named TedBits. Joining us today for the first time is Axel Merk from the West Coast. Axel is the founder, president, and chief investment officer of Merk Investments. He's a frequent financial speaker, web contributor, and author. Welcome, everyone.
Thank you. Great to be with you.
Yes, thank you.
Welcome back. Ty, we were just in the middle of debate. I held you up there. Comments?
Well, I would agree with Axel that, first of all, Disselboom, as he said, it's unpronounceable, in a rare moment of candor, said what the policy is. And and it was the correct one. I wrote an article about it. I said, shareholders first, bondholders second, and depositors last. And it was the first time I'd ever seen that, where it was really the correct pecking order.
And by the way, Dijsselbloem, a few weeks before, didn't receive any coverage in the U.S. He allowed a Dutch bank to fail, and he wiped out creditors. Nobody said a beep. There was no collapse of the euro. It is possible to wipe out a creditor, as it should be.
Well, we see that in the United States. They wipe out creditors all the time. But to me, the concept of deep insolvency and over there is, the banking systems are 400% of GDP in Switzerland. You show the Swiss National Bank here and how much money they printed. And of course, that is Gresham's law. That's people trying to flee to safety, and they have to destroy their currency or be priced out of the market because there's such a small float. But the whole thing with the insolvencies of Europe, I believe that they're so intractable that, Drawley is withholding the printing press. And to me, it's a political exercise. We will print you money if you surrender your sovereignty to Brussels. And,
we have intractable problems in just about the entire developed world. We just
everywhere. No doubt, it's rotten right to the core, including the dollar.
But the relevance here is that we can lament about this all the time. The question is, what do we do about it as investors? Now, you can buy gold, clearly, but what are you going to do with the rest of your portfolio if you don't hold 100% in gold? And I think it is critical to understand the cultural differences in the different regions, and that can help you to understand how policymakers may act, and that may help you in your asset allocation. And that is in that context. Some people, because I'm often quoted as having positive words to say about the Eurozone, I like to talk about the Euro because it's very controversial, and when there's blood on the street, there might be value. But there are, and we, by the way, have not always bought the euro. Sometimes we've been very negative on the euro as well. But there are cultural differences. And as we are morphing to new stages in these currency wars, it will have severe implications for currencies, for equities, for bonds. We just see what's happening here in emerging markets, for example. And so I think it is necessary to understand these differences and not just saying, hey, they're insolvent in Europe, because in the US, we are insolvent as well if we were to, if we were to price our liabilities properly.
Not only are we insolvent, we're not growing in real terms. The only growth we have is really in the money they print out of thin air.
I'd like to wrap up this session on the developed world. Any summary closing comments you want to make on it before we move on to Asia, Axel?
Well, maybe I can make a bridge to Japan, since you have that slide here on the Japanese yen, to give you a little bit more feeling how we look at the world of currencies. In Japan, everything used to be backwards. the more dysfunctional the Japanese government was, and the dysfunctional government is one that cannot spend money, that cannot exert pressure on the Bank of Japan, the stronger the yen was. And that is because the Japanese used to have a current account surplus. When they had a shock to the economy, like the earthquake that hit them, the yen actually went up. Whereas New Zealand, that had an earthquake a little while later, the New Zealand dollar fell. What has changed in Japan is that now the current account has been eroding, and now, importantly, they have a government that's very effective. An effective government is a government that can spend money. It's a government that can put in place a very activist Bank of Japan. And if you look at what's been happening to the dynamics in the yen is no longer the safe haven it used to be. As their current account balance has been eroding. In 2008, the yen was the best performing major currency. And whenever we have had a crisis since, the yen has been less of a beneficiary. Sure, as the Syria issues are flaring up, the yen is still benefiting, but it's not benefiting to the same extent that it used to. And that is really where the problem lies, is that the policies pursued in Japan are not going to be as effective as they think they will. And so they will double down. At some point, when you have a current account deficit, your debt will matter. When you have a current account surplus, it doesn't really matter as far as the currency is concerned. And when you have a deficit, you have to finance your deficits with foreigners by using foreign money. Well, if you can't do that, the central bank has to jump in. So the Bank of Japan will monetize the debt, and they will make sure that these yields are not going to go too high. The valve is going to be the currency. So we think that the yen is going to go to infinity, meaning it's going to be worthless. And those are changing dynamics, and we are keenly looking at those things. And so that's just in the context also of the euro. There are different regions of the world that react differently. And the reason I like to talk about the yen is we're bridging now over to Asia.
Well, the yen is an interesting Austrian experiment as well, because von Mises said you must never let your public know that inflation is the policy of government. And boy, they are shouting it to the hills, and it's going to be interesting to see how it plays off. But basically, we're saying when you do that, you are going to go to infinity, as you well observed.
If they even get remotely close to the 2% inflation targeting, the movement in the bonds, and as you correctly point out, the amount of foreign that they're going to have to draw in, their tax base can't even begin to support it. I mean, we're defining a crisis right here in front of us.
The biggest risk we are facing in the world, not just in Japan, and also in the US, is that the policies that have been pursued are actually working. And the biggest risk is that we get economic growth. If we get economic growth, bonds will plunge throughout the world. That means yields will soar, which means we cannot finance our government deficits. Let's talk about the US here for a second. In 2001, the average cost of borrowing of government debt was around 6%. Now it's a little over 2%. I'm not suggesting we're going to be back up at an average cost of 6% tomorrow, but what can come down from 6 to 2 can also move back up. We cannot finance our deficit if we have economic growth, if we quote unquote go back to a normal environment. We have to continue to have highly accommodative monetary policy. We have to continue to have negative real rates. And that is one of the reasons why gold is defying gravity here, and why gold continues to do well despite the taper talk, despite all the talk that's going on, because we simply cannot afford to have an exit at the Federal Reserve. And the same thing in Japan. We cannot afford that the policies are working, meaning that the yields would actually go up to reflect a robust Japanese economy.
According to Ambrose Evans Pritchard in the Telegram, that the average duration now of the U.S. federal debt is 5.4 years with an interest rate of about 1.88. And I think that's why we're seeing so much activity in the 5-year kind of horizon and movements because of that exposure. Because if the interest rates now, and we're currently, on the 10-year, 2.9 and flat in that part of the curve, we're going to have a major financing problem with the debt already there in place. And as you correctly point out, any kind of growth, and we have a problem.
Yeah, and 2 comments on that. One is Geithner. One good thing I have to say about him, he actually very steadfast.
Well, I got to interrupt because you'll be the first one in the show that's ever had a good comment.
Yeah, well, the only good comment I have for him is that he very diligently extended the average duration of government debt every single month he was in office. So that's the one good thing that he did. But if you look at Spain, for example, an average maturity of about 7 years, that wasn't good enough for them. It is not ultimately about duration. It's about the perception. You can not hide behind durations. You cannot have 5 years to fix your problems, or 7 years in the case of Spain. If the market loses confidence, all of that is out of the window, and you're going to have a problem tomorrow.
Well, and you hit the key word, which is confidence. And it's a, how do you keep confidence? If you are predicating the drop in the bond market with growth, then I guess bonds will never drop, because I don't believe, other than I'll call it nominal illusions, that there is anything that's going to cause the developed world to grow, because they really removed all the incentives to produce. And, real growth, we don't produce more than we consume. The way that I measure growth, we've been in a secular decline ever since Bretton Woods 2, excuse me. And, as you know, the kind of sand they're throwing into the gears here in the United States it's difficult to tell the listeners, but they're throwing 80,000 pages of regulations and new fees and taxes on every segment of the productive sector, which I'll call the private sector. So if it's predicated on growth having a bond crash, then, and Axel, before we're done here, I would really love to hear your thoughts on zero-bound interest rates.
Well, I mean, let's talk about the U.S. first here. We have a slide here on inflation expectations. What it shows is that when you can express inflation expectations in many different ways. This is as priced in the markets, and we can argue whether inflation metrics are right or wrong, but the Federal Reserve looks at many different metrics, and they, by the way, manipulate these metrics themselves. But still, whenever inflation expectations have been coming down, more money has been printed. And so it was very awkward for Bernanke earlier this year to start this taper talk. And then later in July, he clarified that the only reason why he really started the taper talk is because of irrational exuberance that he saw in the market. He didn't use the words irrational exuberance, but he very clearly said that he started this talk about having to wind down some of these policies because of the speculative excesses that they see. And as you can see as well here on the right-hand side of that chart, inflation expectations are coming back up. They need to have inflation expectations high. They need to keep pushing up prices. The reason why they need to keep pushing up prices is because homeowners underwater, at least in Bernanke's book, are not very good consumers. And you're a very consumer-dependent economy. It's one of the reasons why it's so important to know who's going to succeed Bernanke, is because we have to understand what his or her mindset is to think about the economy. We cannot move away from this zero boundary, so to speak, without causing major havoc. Now, if you talk about the zero boundary in the Eurozone, what's very interesting is we're not there yet. The discussion that's coming up is whether they should introduce negative deposit rates. Well, the challenge you have in Europe is that you have the Germans that absolutely do not like these non-conventional monetary policies, but they're stubborn in saying that traditional monetary policy is the only way to go, meaning lower interest rates, including possibly negative interest rates. Well, in Europe, you have high denomination banknotes. You can put a great pile of money into your safety deposit box, including if you're a bank. So you don't have to pay the ECB negative rates for depositing your cash. You can actually have them deliver it, the paper currency. And that's then exactly the opposite of what the ECB wants, because converting that back into liquidity is going to take a little while longer. And so negative interest rates in the Eurozone are talked up once in a while. It's one of the reasons, by the way, why the Euro is stronger than even the folks at the ECB want. They simply can't get this currency to weaken, because whatever they do, people don't trust it. When Bernanke spoke there on July 17, within the 48-hour period, the euro zoomed up 4 full cents, because Draghi had earlier in the month tried to talk down the euro, and Bernanke called the bluff, that they simply are not structurally capable of printing more money than the Fed does, of being even more accommodative than the Fed can. And so we are stuck at the zero boundary. I do think that at some point the Fed will try to get away from it. And as we've seen with the violent reactions we've had when even the talk of tapering has started, the market is going to be most unsettled, and sure enough will run to the rescue, just like emerging markets are getting spooked. And guess what? They'll print money to try to fix the problem.
Axel, I'd like to switch gears here if we could, for the sake of time. I know that our listeners would really like to hear your perspective on what's going on in Asia and the waves of currency issues we see now in Indonesia, we see in India, and right across the board. We've had currency wars almost reverse, where instead of driving down their currencies, now they're trying to figure out how to get them up. Interest rates themselves are now a problem, and we've got capital flight to a fairly large degree, or at least repatriation or reduce risk-off trade that's going on. Can you help our listeners understand clearly what's going on?
One other question. Okay, I believe we do have capital flight, but I believe that it's actually in the scheme of things actually quite small, which says that liquidity isn't as it would appear in countries that have, what would appear to be ample liquidity.
Well, I can give you a bunch of different answers. Let me maybe make a segue from what we just talked about first. We talked about bond prices and this risk of bonds prices falling off and so forth. Historically, the U.S. markets are less volatile than many other markets in the rest of the world. And so interest rate risk has really come to the forefront of investors. And we think the volatility in the bond market is going to persist. Now, if you translate that to emerging markets, in recent years, a lot of money has piled into emerging market debt funds. And these funds, even there's some exchange traded products, some other products, most of these products, they may be actively managed, but they buy the bonds that are the most liquid ones. And those bonds are out on the yield curve, which means you theoretically have interest rate risk. But if you look at how these funds have been behaving, they have been like free lunch. That's because the volatility in the bond market was masked by the easy money. These currencies have been tightly managed. And so you were getting a free ride. You were able to capture a couple of percentage points in yield. You were capturing maybe a little bit of currency appreciation. We've been warning for years that you have interest rate risk in these markets. Now, suddenly, of course, what's happening is Fed-induced, may it be, but suddenly there's interest rate risk. So everybody's running for the exit at the same time. These markets are less liquid than other markets, which means volatility is substantially higher. And so just kind of abstractly speaking, these issues are going to persist, and the weaker countries are going to have a major problem. Now, on top of that, these countries have wasted time. I mentioned earlier how the Chinese are gradually moving towards allowing their currency to be more relevant in the world. Those are steps, small steps that have to be taken. Whereas Brazil, well, they made it as difficult as possible for investors to put their money in, and now they're screaming that they should come back in. Well, it doesn't work that way. You have to build confidence over time. One of the elements in that is, by the way, that you should have sound monetary policy, which means you should not have a very high inflation target, which you're never meeting. But also, as far as your capital is concerned, you should allow the capital to go to a diverse set of industries, and not just into just one segment of the market, one specific bond in your country. And so India is maybe the most extreme example of that. I'm based here in Palo Alto, right next to Stanford. For years, I've been attending a conference on India that they have at least once a year. And you think you're entering a different world, where they think that even during the good times, you have to control capital flows very tightly, because they never want to have the sort of issues that happened in the developed world. Of course, they're getting exactly that. You do not develop your country by having extremely tight government controls and government regulated ways of assigning where your money has to flow. And so all these things are backfiring now, because the Indians are introducing capital controls. Well, when you scream fire in a theater, well, you got to get chaos. And that's exactly what's happening. And so as far as we are concerned, we are focusing, and we show the risk return dynamics. Mind you, these are as of December last year. So since last couple of weeks, some of the things have been changing. But the dark blue points are the Asian currencies. And then the other colors that we have, the gray and the greenish points, are Latin American and other emerging market currencies. And what you will see is that the more developed Asian currencies are more on the upper left-hand side, meaning that the volatility is lower, further to the left, and then the returns are higher. And so as boring as the renminbi, that CNY here, has been, it has one of the most attractive risk-return profiles. Whereas if you go to what I call the fashion currencies, let's take the Mexican peso here, for example. Well, we don't invest in the Mexican peso, not because we don't like what's happening in Mexico, but because the Mexican peso has the highest correlation to the S&P 500. If you look at Brazil, bottom right, you don't want to be there. If you like to invest in the commodity currencies, the Australian dollar is beating the Brazilian real on just about all metrics. But relevant here is that the more advanced economies in Asia, the ones that are moving up the value chain, are the ones that are performing better. And the reason is, it's not just that high-tech gadgets will give you a stronger currency. No. Think about it. Why would a country allow a stronger currency if you manage your currency? You do it because it's the lesser of the evils, because inflationary pressures are otherwise too high. But you can only afford to have a stronger currency if you have pricing power. If you are Vietnam, you can only compete on price. But China has allowed its low-end industries to fail, and they can move up that value chain. So you've got to embrace progress. And the countries that are in the most distress have been worse at doing it, and the countries that are going to win this are the ones that have been much, much better in embracing change.
When I look at the weak economies, and right now they're obviously the ones with the negative current account balances. You look at India, they're there. You look at Indonesia. I was reading the notes for the Jackson Hole Summit, and I was really taken back with some of the things that they were grappling with. And major problem, we have such global imbalances of trade. We all know that. That's nothing new. But they call it the dilemma, the trilemma of international finance, the impossibility of having free capital flows, fixed exchange rates, and an independent monetary policy. And they just don't work together, and you can't get the agreements. And the solution is you got to kind of have targeted capital controls, tough bank regulations, and domestic policy to cool off credit booms. But none of that happens either.
I would disagree that you need tough capital controls. What you need structural reforms in those countries to absorb the capital in a more prudent fashion. You need to, the Chinese, for example, the reason why they can't buy anything. They can buy Californian real estate. They can buy apartments. So they buy apartments that are empty. They can buy the stock market. They can buy some precious metals. But they don't have opportunities really to invest their capital. One of the, it hasn't received much attention, but one of the most important announcements recently out of China is that the Politburo wants to have greater competition in the banking sector. Now, that doesn't mean that everybody has to open the floodgates of liquidity there in China. But what it means is that credit must be priced according to the risk profile of the folks who want to have money. Right now, state-owned enterprises in China have abundant access to credit, but small players have to go to loan sharks. Well, if you can price the loan according to the risk profile of the borrower, you can have an entrepreneurial boom. It's those sort of things that need to happen. And if you pursue those, you don't need to have capital controls at the other end of the spectrum. Now, everybody in the world is always just fighting the symptoms, but with that, you're only going to cause more problems. Capital will always find its way. One of the reasons why the Chinese statistics are so wrong is because people find a way around the controls, and so then it pops up somewhere else. Capital controls have never worked, and they never will. What helps is that you pursue sound policy, and some countries will obviously never do it, and others are better than others.
One of the leading minds at that Jackson Hole Summit from the London Business School, I think her name was Helene Ray, she laid out to the audience, she said, the choice is this: impose capital controls or let the Fed run your economy. Effectively, that was the net that she spelled out. I thought that was pretty startling, but it begs a lot of questions when we have the leading minds in the world grappling with this, and they have no real, I won't say understanding, but a real appreciation of what the solutions that are.
Well, what that refers to is that clearly if you fix your exchange rate, you are inviting Fed policy because they are dictating what you do. Now, what
Exactly.
some of the more advanced or sophisticated countries have been doing is Singapore, for example, has its central bank issue short-term papers. And with that, they can mop up some of that liquidity. Now, it's one of the reasons why the reserves have been building up so strongly. But that's only a buffer. Ultimately, the money will find its way into these markets, typically into the real estate markets. And so all of that is a way to buy a little bit of time. But the more prudent countries are in the meantime embracing reform, and most countries don't, however. And with that, they're only inviting to have a big problem later on, and that's why there's call for quote-unquote aggressive action, whereas the aggressive action should be on the substance to develop their economies more rather than just cry foul and point the finger. We don't like Fed policy either, but it just doesn't help to just always blame the other guys.
Precisely. Ty, you had some points?
It doesn't matter whether it's China or Thailand or Germany. These are all economies that produce more than they consume, and they create capital. And the ones that aren't are the Indias, are a lot of sick people in Europe. And actually you talked about, loaning to entrepreneurs, just how long is it going to be until we actually have prudent underwriting standards going and actually people getting access to credit according to their ability to repay? I would argue that those kind of prudent measures that we grew up with are really going the way of the dodo bird.
Well, you must be much older than I am because I've never really seen them to be too prudent. But having said that, what is relevant here is though on the one hand the direction and secondly the pace. I've been praising China, but by all means there are many things that are not good in China. But they're taking baby steps in the right direction, whereas much of the developed world is taking giant steps in the wrong direction. The one country that's kind of winning out here is Singapore, where they are calling everybody, hey, build your business in Singapore. But not everything is perfect in Singapore either. And so it's the trends that are important. And as far as investments are concerned, it's the marginal change that will affect the pricing of whatever you're investing in.
Well, Singapore is one of my favorite places, and I'll call it a benevolent dictatorship, and he actually has a long-term view. He's I'll call it a stationary bandit rather than a moving bandit. A moving bandit to me is like Barack Obama, who needs some money right now, and he's going to be out of office in 8 years. But he gets a stationary bandit is somebody that knows that he's going to be around for 20 years and doesn't have to bleed the private sector over a short period of time, and actually would rather collect coupons over a long period.
Yeah, but Singapore also has its set of challenges. You have the previous generation, the brightest wanted to work in government, and they've done lots of good things. But if you look at, for example, I was in Singapore a couple of months ago, the venture capital industry, for example, in Singapore is tiny. You do build a big banking sector there, and they're going to manage probably more wealth of Asia and the rest of the world than anybody else. But the innovation, there are very few patents filed, for example, in Singapore. So and people are becoming more and more risk averse there, as far as kind of innovation is concerned. And so not all of and in the meantime, it has been booming so much that they had a flood of immigrants. And now they've priced everybody out of the market. I mean, the problem we're familiar with here in the Bay Area, that the service providers, the firefighters, cannot afford to live in the Bay Area because it's so expensive. And so there are some major challenges that they have. The good news is, as a currency investor, the Monetary Authority in Singapore is taking inflation very seriously and is going to have tight monetary policy to try to cool down some of these pricing excesses. But still, Singapore has just very different challenges than we have.
And Singapore's like China in that it operates a currency peg, right?
It's not a peg. It's the Monetary Authority in Singapore, different from any other central bank, is managing the exchange rate, using the exchange rate as the primary tool, because it's such a trade-based economy. Now, ultimately, what Singapore is actually the first central bank that had inflation targeting. And they are the closest one to one being based on a quote-unquote Taylor rule. And so we, for the longest time in our hard currency strategy, didn't touch the Singapore dollar because of that, because they weren't focused on inflation but on the exchange rate. But then, especially as the crisis in the Eurozone flared up, we actually used the Singapore dollar as a substitute for the euro, because ultimately it doesn't matter what people say, it's what they do. And the Monetary Authority in Singapore has had one of the most prudent ways of managing its currency, and with that managing monetary policy, than any others. But it is a managed float, but it is still a far more liberal regime than what China has.
A final question for Axel, Ty, on Asia.
Yeah, I would just love to actually hear some, we talked about Japan in the developing world, but really Japan's lobbing bombs all through the Pacific Rim. and what you see is as the repercussions of that intermediate term, because as you well know, the yen's plummeting against everything while everything else is plummeting against the dollar. And how do you see those tensions playing out, and where are the opportunities?
Sure. Well, maybe a few more words here. Yeah, we focused on the negatives of the Japanese money printing, but of course, one of the side effects is that Japan is going to invest a great deal abroad, as companies want to invest abroad and get some of the capital out of the region. Korea in particular had been very concerned about what might happen to their economy. But keep in mind, when you build a cell phone, you're not going to substitute your components with Japanese components simply because the price drops a little bit, especially if you're a Korean-based manufacturer. And so the substitution effect there doesn't happen so quickly. Also, the Japanese would love to invest more in China, so Taiwan is going to benefit from that. So on a net basis, the kind of this very aggressive policy hasn't had this negative fallout on the rest of Asia as much as other things have had. What it has done, actually, we haven't talked about that place quite as much, is the Australian dollar, for example, is historically quite volatile. Historically, if the sort of slowdown that has happened in Australia would have happened, the Australian dollar would have plummeted far further than it has already. But because of this amazing money printing in Japan, there's actually quite a buffer in that, and so that's why the Australian dollar hasn't come down any further. Now, another way to think about this, by the way, is that we sometimes cynically say that we've never had a Eurozone crisis. That's the good news. The bad news is we have a global financial crisis. If you think about it, we talked about Cyprus earlier. Well, Cyprus is tiny. Japan really matters. Japan is huge. And so if we are correct, and I don't know whether we are right, but I think there's a risk that we are right. If you think there's a risk that we are right, that the Japanese are going to have a major problem, well, that's going to have rather dire consequences for the rest of the world. And so that's just to end this on a cheery note here, that the engagement of policymakers, we believe, is going to continue to be very active. And with that, of course, there are going to be opportunities. And we think the currency markets are a low volatility way of playing that, because you don't have to take on the equity risk or the interest rate risk that you would do to most other means of investing.
Ty, any final comments you'd like to make as we wrap up here?
No, just that we're in a maelstrom, and there are so many unknown unknowns and a lot of known unknowns that it's just going to be a constant challenge, and but the opportunities are as great as the pitfalls, and I want to just thank Axel for joining us. He just has been a fountain of insights.
Axel, any comments that you'd like to leave with our listeners in terms of the developed world, the United States, or Asia that you think are important that we haven't touched on?
Well, again, the world is becoming less and less stable. That doesn't mean you should hide under your pillow. That means you have to take an active approach to your investments. That means that the mom and pop saver is going to lose out. It means that if you're a hedge fund, you're going to thrive. The greatest contributor to the wealth gap is not the policies of Democrats or Republicans. It's monetary policy that's driving that wedge. And so you got to take an active role. And we try to, obviously, we don't have the answers to everything in the world. But we like to give, our audience a macro way of trying to assess the dynamics. And so if I can just give a little pitch here for what we do is, we publish, our insights where we give, frank commentaries on how we see that these dynamics are playing out. We publish white papers for anybody who wants to dive a little bit more into depth about correlations, volatilities, risk returns, whatever it may be. We have white papers. We publish gold reports where we talk about how gold can fit into a portfolio. We are contributors on a couple of websites here where we blog. The best way to follow my blogs is to follow me on Twitter. My handle is Axel Merk. And so through all these means, we try to communicate what we do and give investors an opportunity to look at angles that they don't think of every day. You may disagree to my views on Europe, but I would hope that the perspective that I'm providing is getting you to think. and that you don't just follow the mainstream opinion on everything. And then I think if there's one thing to be said is that while we've had a consistent framework to look at things, we have very often rattled the mainstream opinion. And the way we get our opinions is by going to the sources. In China, for example, 9 months before the Politburo transition was announced, we have a native Chinese on our staff, went into the bios of the various candidates. We published a white paper on that about the different political factions and how that may impact Chinese policies going forward. So you don't have to be surprised when the Politburo is announced and they say, oh my God, this is what they are. No, then you actually have done your homework. Similarly, be that on the European Central Bank, the Bank of Japan. In Japan, a year before the latest bout of members was announced on the Bank of Japan, we started looking at the potential candidates. So that ahead of time, you can make up your mind and then make a decision. We happen to prefer the currency markets to express those views. And we do it through mutual funds. Obviously, feel free to check out our products as well to learn about what we do, whether they're suitable for you. But the main thing we like to do here is to educate people, to get them to understand the sort of risk they're facing as these crises are morphing to new stages.
Axel, thank you for being so very gracious with your time here in this last few sessions. It's much appreciated. And I think a lot for our listeners to think about. Looking at your masthead, and it says the authority on currencies, and I clearly see that here in our sessions, and I think our listeners did too. Ty, thank you for your time. I appreciate this, and we'll have you both back at another date.
My pleasure.
Thank you.
Thank you very much, Axel. Thank you, Ty.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonT.